Hey everybody, Chuck Barone here. Friday, February the 2nd, 2024. Let's wrap up a crazy ass week on Wall Street this week. Wow, okay, so what a difference a week makes, right? Anyway, before I get rolling on the show, I got a lot to cover today. I just want to welcome everybody to the show as always, and thank you guys for your support. Appreciate you guys showing up, watching these videos. You're cool. Anyway, markets today. So we knew today was going to be a huge day. Jobs numbers. We knew we were going to get consumer sentiment today. The University of Michigan, two huge pieces of data. We got them both, and boy, did it make the stock market's heart warm up and go expand. Wow. So the market's flying today. Stocks up across the board, going crazy. You got the Dow up 134 points, 38,654. Nice. NASDAQ up 267, 15,628. Nice number for the NASDAQ. And the S&P, another new world record, up 52 points today, 4,958 on the S&P 500. Strong earnings, strong economy, consumer sentiment soaring, stock market, okay. Look, I think that a little early yet, but it looks like, this could be a pretty good year for stocks if companies can keep earnings. That's obviously the main driver of what drives the price of stocks is earnings and the anticipation of earnings. And it looks like both of those are pointing up right now. Now, the bond market, on the other hand, that went the opposite way today. The jobs report basically killing the idea of a rate cut coming in February. Bond market now obviously overcorrecting. So listen to these numbers, guys. The 10-year jumps 17 basis points today, back up over 4%, 4.03%. That's a huge move, guys. The 2-year jumps even more, jumping 18 basis points, now at 4.37%. So bond market correcting in a big way. The data today pointing to a strong economy, no rate cuts. Bond market shows it, man. That's painful. When you see the bond market, those yields jumping like that, that means prices are declining like that. Because it works like a teeter-totter, right? So when yields go up like this, prices down. Bummer. So when you can see these yields jumping up, bondholders losing money. Dollar today, big rally on the dollar, up almost a full point on the index, 103.96 now, almost back up to 104 on the index. Dollar being I shouldn't say super strong, the dollar being strong. And of course, news like this, no rate cuts bring the value of the dollar down, obviously. And higher rates support the strength of the dollar. No rate cuts, dollar rally, bang, there you have it. Simple stuff today. The gold and silver today, well, with a strong dollar, we know what happens with gold and silver. They're going to fall. Gold falling $14.50 an ounce, $2,040.70 for an ounce of gold. So a good strong number still for gold. Silver falling 49 cents per ounce, $22.65 for an ounce of silver. And I tell you guys right now, this price is lagging. You're going to see silver get to 25. You'll see that. Oil today, down again, down $1.54 a barrel. Now $72.28 per barrel for West Texas Intermediate. Exactly what we've been telling you guys was going to happen. It's the trough between $70 and $75. And I say that generally. We could get charts out and narrow it down, but generally between $70 at the bottom, $75 at the top, that's where oil wants to be trading. It'll break out occasionally like it just did recently, but the breakout never lasts long, and it comes right back down into that trough where it's been, and that's where it's going to continue to stay until we see a sustainable breakout, which we have not seen any sign of yet. Bitcoin today rallying up a little bit, up $149, $43,098 for Bitcoin, still holding up strong. Bitcoin, a good strong number. So this was a interesting finish to this week. So the markets kind of go all over the place. We had a lot of stuff this week with the Fed, with Powell, disappointing the stock market, which had priced in so many rate cuts. The bond market did not getting exactly what they wanted. I'm having to rearrange their bets on the table. You can see the result of this week, a week of just some wild, crazy gyrations all over the place. So let's talk about this jobs thing today, because that's the reason, well, start of the reason why this all went like it did today. Jobs, just basically, guys, here's what it is. The final nail in the March rate cut idea. Okay? Not going to happen. Now you can pretty much say with absolute certainty it's not going to happen unless something catastrophic happens. The experts totally missed this one big time. Like they tend to miss, but big misses like this, not usually. Jobs coming in at 353,000 jobs for January. They've been calling for 185,000. So they're almost doubling it, what they were expecting. The job market staying super hot. And it's interesting because the media, everything I'm reading in the media is only about job cuts. Especially in California where these tech companies, Google cutting, Meta cutting, this bop. Well, according to this, everything was up. They even added 23,000 jobs in manufacturing. Whoa, go figure, right? So, like I said, this is the final nail in the March rate cut idea. Now let's see where they're going to place their bets for the first cut. Most people talk in May now. I think that really might be still optimistic. As I've said before, guys, remember, the Fed doesn't cut interest rates just because the market wants them to, or just because they raised rates like they have so much. They cut rates to stimulate the economy. That's the reason they do that. Like they've been raising rates to slow the economy down, or try to. Imagine if these rates were still where they were, where this economy would be today, man. We'd be overheated like crazy. So they're trying to slow things down, especially jobs, which they have obviously not succeeded at. Wages also rising significantly, 0.6%. That's a big number. Annually, well over 7%. So that spooks them. Again, no reason to cut rates. This was not a shock. I've been telling you guys the Fed needs a reason, an economic reason, not a political one, to cut rates. Well, we haven't seen that reason yet, right? So forget March. That's out. May's the target from what I've been reading. We'll see. I think it's going to end up going a little further than that. I don't know if the economy will be in bad enough shape by, the end of spring or in springtime in May for them to cut rates. I just don't see that happening. All right, so let's talk about the other big news of the day. The University of Michigan Consumer Sentiment Survey. And this is a really big one, guys. This one measures a whole bunch of different components of the economy, and the numbers jumping again. So consumer confidence really on the rise. So, I know that politically it's, there's half the country wants the economy to do crappy, right? Politically, they don't like it. They think the other team's going to get credit or whatever, so they really don't want the country to do well. So they don't want to believe anything, that the numbers or anything else. And it doesn't matter which way it goes. Like if there's a Democrat in the White House like there is now and the economy is good, the other team Republicans are not going to be happy, and vice versa. When Trump was in the White House and the economy was doing good, the Democrats were trying to spin it out. Well, I guess that's just politics. But the numbers on University of Michigan show a lot of interesting things, guys. So the index itself made a big jump this month. Let me get my peepers on because there's some written data here I have to read. Consumers gaining big confidence in the economy, not for the economy right now and the economy going forward. The index sat at 69.7 in December, jumping to 79 even in January. Well, that's a pretty big jump, man. Almost 10 points on the index. It's the highest level on the index since July of 2021. So this is the overall feeling consumers have about the economy, okay? Now this number is encouraging to show that consumers feel like the economy is, I guess they're getting past the shock of the inflation, right? So it's a good, encouraging number, but here's the thing. Before the pandemic, before the big inflation, this number was around 100. So while it's up significantly from 69, even below that, it's still a pretty big difference from when it was before the pandemic to where it is now. Okay, but here's the interesting thing. The index, like I said, it does measure several different components, and they all went up pretty sharply. The current state of the economy. How do consumers feel about the current state of the economy? On the index, jumped to 81.9 from 73.3 in December. That's a pretty good jump. Expectations for the next 6 months. So what do the consumers feel like the next 6 months is going to be for the economy? Jumps from 67.4 in December to 77.1 in January. Okay, that's a pretty good jump there as well. Also, consumers expecting inflation this year for 2024 to be 2.9%. And it's right now, I think the last measure was around 3.4%. So we're expecting inflation to come down and stay down, but not get to the Fed target. Okay, so it's interesting that they don't believe they're going to get to the Fed target, but they still believe like we're going to have a lot of rate cuts. That's interesting. So this consumer sentiment today also supercharging the stock market, because when you put this together, great earnings for companies. Truth. Jobs. Even though the media portraying it as pretty negative, it's not, obviously, by this measure. Consumers feeling like things are not only better now, but going to continue to get better over the next 6 months. And they're feeling like inflation is going to be stable and not rising. So this is all of this shows pretty good signs for the economy this year, right? Now it'll be interesting to see what the Fed does with interest rates. Because when you have an economy that's already kind of going good, you don't really have an economic reason to cut rates, other than the squeeze you're putting on costs for corporations who borrow money, on real estate, which is killing our industry. But is that enough of a reason for them to cut rates? Even with jobs, even with consumers spending money, even with earnings and companies still, doing very well? I don't know. It's going to be fascinating to watch it. We'll bring you the news. And finally today, to wrap it up, our friends at Blackstone adding 38,000 single-family houses by buying up fellow institutional landlord Tricon. So Blackstone now, they can't be bothered going in and buying houses, a few at a time. They're going to buy companies, scoop up all the guys smaller than them, picking up 38,000 houses now. Guys, I've told you, you've heard me complain about this. These institutional buyers are going to create two classes of people in this country. They're going to make it impossible for regular consumers to buy a house. They can take over the entire real estate market. They can do it quietly. Not many people even are aware of this is happening. They just keep wondering why prices stay so high. Well, this is why, guys. Well, this is a big reason, big part of the reason why. They said by 2030, by 2030, institutions will own 40% of the single-family houses in this country. If you want to have that where, it's a two-tiered system where you have people that don't own property and people who don't and never will, because the only way you're ever going to be able to get property is if you own it and your property is appreciating with the property that the commercial institutions own. So this is not good for the American dream, guys. Unless you're a giant shareholder in Blackstone and that's your American dream. But anyway, that's all for this week, guys. It's been a crazy one. We'll be back next week. It's going to be another big week. Start off a big month in February. We know we're going to have a lot of excitement. January was a great month. And we'll see where it goes. In the meantime, have a great weekend this weekend. Get out of this Wall Street, get out of work, and just enjoy your families and your friends. Relax and recharge your batteries. No Super Bowl this weekend, no football, so enjoy your extra day. I was teasing. I said I get an extra day every week now. The Sundays open up for me. Enjoy your extra day, guys. We'll be back on Monday. Until then, take care. Thanks.